Hello everyone, this is Ted Bauman here, editor of Bauman Daily, the Bauman Letter, or Profit Switch, with your Friday Bauman Daily video. Today I'm going to do something a lot of people think is impossible, and that's to try to explain how options trading affects the market. And certainly we've seen evidence of that the last couple of days. This is options expiry week, and it's having a predictable effect. Before I do, I'm wearing a new t-shirt today. Somebody wrote in and say, hey, we really like your t-shirts. Show us some of the wilder ones. So here's today's Sauron. I'm sure a lot of you know who he is. The market had a pretty bad week. Here's a chart that shows the S&P 500, but more importantly, the Russell 2000, which is more reflective of the kind of stocks that we tend to trade in places like Profit Switch and some of our other services. You can see that yesterday was a really bad day. It was a big fall at the end of the day. And it's continued today. On the other hand, the broader market is ticked up a little bit today, but really the key thing is that a lot of the stocks that people have, that they hold because they want big gains, have seen pullbacks this week that are close to the 5% level. That's certainly the case for some of the, for our portfolio, particularly the Profit Switch, because that's the kind of sector that we're exposed to. Now, I don't take responsibility for that fall, and I'm going to show you exactly why. The first thing to understand is that options trading has become incredibly important in today's market. Here's a chart that shows what's known as the options speculation index. That's the blue line below. And it shows the relationship between options trading and the broader market. And it's now really at all-time highs. Well, at least going back to about the last 5 years, but that is all-time highs. And it really is a question of people piling into options markets. Here's a second chart that shows that the single stock options trading, the kind that small options traders, the volumes are bigger than share volume tradings for the first time. That's actually what's starting to happen. And we've seen a situation like this. This is actually last year, July. So this shows you the trend in 2020, but it's continued this year. It's pulled back a little bit, and fundamentally, the whole approach to options trading has become a part of the retail market, and that's I think an important consideration, is that you've got lots of small traders who are buying large numbers of options contracts for the first time, not just the big institutional guys. Now, this is the critical chart here. This shows the relationship between volume levels in the overall stock market and volume levels in, or rather the direction of the stock market versus volume levels. We've seen the stock market increase this year quite substantially with declining volume. And one of the reasons for that is because the number of individual trades, the discrete individual trades, has declined as retail traders have backed out of the market and moved into options. And that has left a lot of trading to institutional traders who tend to trade large blocks. So it's fewer volumes of actual trades, but larger trades. Now, what has this got to do with options, and what has that got to you? Well, the first thing is that we need to understand something called the Greeks. The Greeks are measures that show the relationship between the price of a stock and the price of its options. In other words, how they change with each other. The first important Greek is called delta. And delta of an option expresses the option's expected price change relative to the changes in the underlying stock price. So, for example, a call option that has a plus 0.5 delta will be expected to gain 50 cents in value for every increase in $1 in the stock price. The same option would lose 50 cents if the stock price falls by $1. So that's what delta is. It's how much that you expect the option to trade relative to the stock price. Gamma, on the other hand, is the rate of change of an option's delta, because delta is not static. Delta changes over time. Now, if gamma is positive, what we call long gamma, then the option's delta will increase when the stock price increases and decrease when the stock price falls. So, for example, an option with a gamma of plus 0.5% will see its delta increase by 0.5 every time there's a 1% move in the underlying stock. So the basic idea is that if you have a long gamma scenario, then there's going to be an increase in delta, which makes the stocks more volatile. If gamma is negative, if you have short gamma, then the options delta will decrease as the stock price rises and increase as the stock price falls. So basically, you can think of gamma as the delta of delta, if you like. It's how delta changes over time. Now, the critical thing to understand here is that these things have a powerful impact on the way that the overall market behaves, and that's what we're seeing this week. Now, remember that options trades depend on market makers, the big institutions that sell the puts and calls that retail buyers buy. Now, those market makers have to hedge their positions to avoid loss. They do that by buying or selling the underlying stock underlying an option. And since we've seen such an explosion of option trades, this kind of market making hedging has become increasingly important this year. Now, because the price relationship between options and their underlying delta constantly changes, i.e. gamma, market makers are constantly adjusting their hedging strategies. And here's how they do it. That can have a big impact in the market. When there's a long gamma situation, market makers hedge by buying more of the underlying stock as it falls, and vice versa. If the stock rises, they sell some. That has the effect of suppressing volatility by propping up the price of stocks that would otherwise fall, or boosting the price, pulling back the price of stocks that would otherwise be rising. Now remember, they're doing this because of the nature of a long gamma situation. And remember, long gamma is when the options delta will increase if the stock price rises and decrease if the stock price falls. So it's in their interest as market makers to try to keep the stock prices stable to avoid risk to the fact that they are on the other side of the options trade. Now, in a short gamma situation, market makers hedge by selling more of the underlying stock as it falls and buying more of it as it rises, which tends to amplify price moves and leads to big volatility. Now, the 2020 COVID crash is a good example of this. Here's a chart that shows up until late February, they say that because long gamma was the dominant perspective in the stock market, in the options market, because it was primarily a long gamma market, institutional traders tended to keep prices relatively trimmed until options expired on February 21st. And it was at that point that stocks began to fall. And that's because the whole situation switched to a short gamma environment, and that led to much more volatility. So in this case, options trading and a short gamma situation led to a rapid decline in prices. It wasn't just individual retail traders like you and me panicking and selling. It was options traders adjusting their hedging strategies. Now, that is an important thing to remember next time there's a big pullback, because if you get pulled up in this without knowing that options trading can reverse course very quickly, you can lose a lot of money. So we saw a turnaround in mid-March when the market basically led to what they call zero gamma, and it began to revert to a long gamma position again, and then the market began to rise. Now, the important lesson here is that big market makers, hedge funds, and other institutions that engage in large-scale options trading, either as a seller or a buyer, are manipulating markets constantly to protect their options trades and to protect their positions. That can have a huge impact on stock prices. That's the main message here. Now, the thing about the gamma, the fact that delta changes as time goes by, is that it tends to become much more pronounced closer you get to the expiry of options, which tends to happen at the same time every month, which they call the witching day, the day when options expire. Now, what happens is that the gamma of an option, in other words, the amount that its delta tends to change, increases as you get closer to the expiry of the option. That means that the risk of sudden moves in the stock increases for the market makers and the hedge funds who trade in a lot of options. Now, the simplest scenario is when market makers need to buy a stock to hedge a call option that they've sold. Because they're the seller of the option, their own gamma is the opposite of that of the buyer, i.e. they are short gamma, which means that they stand to lose if the option increases in price. So the paradox is that the closer the options, those call options get to expiry, the more these market makers have an incentive to try to buy the stock to stabilize its price. Because remember, the gamma, increasing delta increases their risk. So they have an incentive to manipulate the market to keep the stock from being too volatile. But there's a more complex scenario where large institutional buyers of options, not market makers, but hedge funds, they buy long gamma options and they want the underlying stock to keep going up. But if the price rises too quickly, too close to expiry, you could get a sudden pullback. People like me and Clint Lee who look at charts and look at the MACD and the RSI, we look at a stock and say, hey, this stock is overbought, so we're going to sell it. Now that means that at that point, the high gamma of that stock will lead to a rapid change in the options price, which is very dangerous for the buyers of those options. So that, in that sense, it makes sense for these big institutional buyers to sell some of the stock in order to try to suppress the volatility of the option itself. Now, that's one reason why long gamma markets tend to be less volatile, because the market makers and the hedge funds have an incentive to do things to keep prices from moving too much in either direction. But here's the problem, and it's the problem that we've seen this week. That lack of volatility can disappear almost instantly once market makers and hedge funds have closed their hedging positions. Because when you're close to expiry, you don't need to hedge anymore. So what you want to do is sell whatever it is you've been holding as a hedge. Now, once the options expire, those big traders just basically sell the stocks. And if they're holding long gamma options, they just stop buying them altogether. That pulls the floor out from the market. Now remember, this is not something having to do with market fundamentals or having to do with the fundamentals of the individual stocks. It has nothing to do with the prospects of the companies involved. But yet you can see 5, 6, 7% declines in the price of certain relatively perhaps lightly traded stocks, maybe growth stocks, niche stocks, startups, that sort of thing, that have a lot of options trading going on behind them. Now, this phenomenon is why the last week of an options life is called Gamma Week. Now, here's how Gamma Week has played out this year. Some of the worst sell-offs that we have seen on a monthly basis, May, June, July, and now again in August, have come around the monthly options expiration date. Now, the reason I'm saying this is partly defensive, because I know that a lot of you out there are subscribed to my newsletters, and you're looking at the stock market this week, and you're going, hey, Ted, what's going on? Here's what's going on. You're getting big market makers and hedge funds that are manipulating markets for their own benefit, but they're doing it, it's not illegal what they're doing. They are buying and selling to hedge options trading. The more people trade options as a alternative to trading stocks, and I'll show you this chart just once again. Here's the chart that shows the rise in options trading relative to the stock market. The more that happens, the more volatile we're going to get when it comes to options week. And the more it behooves us as investors to be aware of this and to buy the dip. Because if the prices of these stocks are going down as a result of hedging activity on the part of big institutional investors, it shouldn't matter to the individual owning the underlying stock. Buy more of it. Anyway, that's my message for you this week. Hopefully I successfully explained the Greeks and their relationship to the market. I did my best. We'll talk to you again next week.